I've always said it's either something or it's nothing. If it's embraced as an institutional asset, if it's legitimized as an asset, then it's not going to zero. And if it's not going to zero, it's going to a million. At this point, you just have 95% of the world that still doesn't quite understand what it is. And that means, the way Bitcoin marches from 100,000 to 13 million, it's growing 60% a year for quite a while now. And I'm forecasting it will decelerate to 20% a year over 21 years. But that means on average, it grows about 29% a year, ARR. And that 29% a year for 21 years gets you to 13 million a quarter.
Michael Saylor has always said, Bitcoin is either something or it's nothing. Today, that statement resonates more than ever. With Bitcoin recently hitting a new all-time high above $118,000, its status as a global institutional asset is undeniable. The idea that it could fail and drop to zero is no longer a realistic scenario. What's left to consider is the other side of the bet, the potential for Bitcoin to become the most valuable asset of the digital era, with significant upsides still ahead. Most people around the world still don't fully understand Bitcoin, which is exactly why Saylor believes the biggest gains are yet to come. He forecasts Bitcoin growing at an average rate of 29% per year over the next 21 years. If this trend continues, each Bitcoin could eventually be worth as much as $13 million, a transformation that would make it the most powerful financial asset on the planet. Stay tuned until the end of the video, where Michael Saylor breaks down his long-term outlook, the math behind his projection, what's currently driving Bitcoin's price, and why the greatest opportunity may still lie ahead.
Check off that box, which is company adoption. Then after that, you've got like institutional adoption, the endowments and the pension funds. There's now pension funds that are starting to allocate to Bitcoin, and there'll be big university endowments and 501c3s and insurance companies. And so that's another driver. And then you've got nation states. The US already has about 1% of the Bitcoin. If they don't sell it, that's a big deal. And Donald Trump said, never sell your Bitcoin. So I think that that's also positive. So let's just say there's a lot of different entities in the world with capital. Who doesn't want to keep their money? Who doesn't want more money, right? Everybody wants to either keep their money or they could use more money. And so Bitcoin is digital money. It's the greatest digital monetary network in the world, but maybe it's the first example of what I call digital capital. It's money, just so I can help people not be confused. Money is a generic term, but it decomposes in the modern world into two elements: currency and capital. Currency is the dollar and the peso and the euro. That is the medium of exchange asset. It is designated legal tender. That means you can swap it without paying a tax bill on it. And it means it's liquid and fungible, and probably it's good for paying taxes, and everybody prices things in it. That's not going to change. The world reserve currency is the dollar. The dollar's been the world reserve currency since just after World War I. And in different forms, the dollar is getting stronger, not weaker. But there's another aspect of money. It's store of value. If I had a liquid fungible asset that was a store of value that I could give to my children's children, well, nobody thinks that's the dollar, and nobody in the U.S. thinks it's the dollar. Rich people in the U.S. don't have 50% of their assets invested in dollar bills. And what they do think it is in the modern world is they think it's the S&P index, like the Vanguard 500 or SPY or some index fund. Or maybe they think it's real estate. And real estate's a store of value, but it's not liquid and fungible.
Still paying taxes on your crypto gains? What if you didn't have to? With ITrust Capital, you can buy and sell crypto inside a tax-advantaged IRA, giving you a smarter way to grow your portfolio without worrying about capital gains tax. That's why they're the #1 crypto IRA platform in America, with billions in tax-advantaged transactions. There are multiple ways to fund your account. You can make a contribution, transfer an existing IRA, or roll over an old 401k or employer plan. You'll get access to a wide range of digital assets, low fees, and 24/7 trading, all backed by secure, one-to-one asset ownership with institutional-grade custody. And if you have questions, ITrust Capital offers 100% US-based customer support with real people ready to help. Click the link, use code DOSE7, and get your $100 funding bonus today. Start building your crypto wealth, tax-advantaged, with ITrust Capital.
So it's a little bit different. It's difficult to swap it out in units of $1 million every day. And so it's not quite money, but it is capital in that regard. And gold for 5,000 years was kind of capital. It was a bar of gold bullion was that long-term store of value asset that people use. Bitcoin is emerging as digital capital. And people, they're not going to use it as a medium exchange to buy a cup of coffee. But if you want to buy something to give to your granddaughter that she can't mess up, even though she's 3 years old, and you just want to, and you don't want to worry about it every day, and you don't want to trade it, and you don't want to worry about antitrust and whether or not there'll be rent control on the building or renting it out, you just buy her one Bitcoin. And you put it in cold storage, and then 60 years from now, she'll be rich because the one Bitcoin will probably be worth 50 million or $100 million, right? And so that what's going on right now is the emergence of Bitcoin as a digital capital network for the world. And the thing driving it from 100,000 to 13 million over the next 21 years is the adoption of it as a capital asset by people that have the wealth, have the capital. The risk-free rate for Bitcoin, as I just described it to you, 29% over 21 years, about 30%. So the way I look at investments is when you're pitching me an investment idea, I say, well, I've got a lot of money in Bitcoin and I'm expecting about 30% risk-free for the next 20 years. You have to actually pitch me an idea that generates more than 30% plus the risk premium plus the tax efficiency. If you told me here's a thing that'll make me 50% a year, but it was going to be taxable, that might be 40% a year or 35% a year. And I'm like, well, after the risk, it's still not as good as my risk-free rate of 30%. So if you're capitalized on Bitcoin, if you understand it, and if you understand, and if you have a long time horizon, if you're going to hold it more than 4 years, you don't care about the volatility. All you care about is the annualized return. Well, the dollar is zero ARR, zero volatility. That is to say, the dollar goes up 0% against itself each year, and the dollar is zero volatility against itself each year. So if you're on the dollar, you're living in flat land, and you're a stationary person in flat land, a pedestrian in flat land. Bitcoin is going up 60% a year against the dollar. How long? Well, since MicroStrategy made its first investment 4 years ago, it's 60%. But if you stretch back 6, 8, 10 years, I think it's also 60%. So like a decade. But you can measure it back a decade and you see it's going up 60% a year, and it's 60 volatility. It's a 60 vol against the dollar. So you should think of Bitcoin as an asset. It's like you're on a speeding train going 60 miles an hour and you've got a flywheel spinning 60 RPM. And the pedestrian on flat land is standing on the plane watching the train go by, thinking this is scary. It's going to suck the oxygen out of my lungs. And they're thinking, my money isn't an asset because it goes up 0% a year. So they have a different view toward money than the view of someone on the Bitcoin train. The person with $1 million of cash is going to have $1 million of cash in a decade. A person with $1 million of Bitcoin is going to double their capital every 18 months. If they just hold on to it, right? And so they're going to double it once, twice, 3, 4 times at that rate. Howard Marks would say volatility is not risk. Volatility is volatility, right? A merry-go-round, or a carnival ride or a roller coaster is volatile. The risk part is if you fly off the roller coaster, right? If the merry-go-round stops working, etc. So the fundamental risk of Bitcoin is the existential risk of an extinction level event and Bitcoin, right? If space aliens come down and say, we're taking your Bitcoin away from you, right? Then I guess there's risk. If some evil genius finds a way to create a cyber virus that infects and destroys the Bitcoin network instantly, irrevocably, that is the risk. So, but that's kind of like that's the existential risk you take when you get on the airplane. If it crashes, that's the existential risk you take when you cross the street. That's the existential risk you take when you put a piece of food in your mouth. And I say, and you say, well, can you imagine that hurting me? And I say, yeah, if I put poison in the food, you're dead. Okay, so do you trust me? Do you trust the waiter when you put the food in your mouth, right? So yes, there is some risk in life. And the existential risk is that extinction level event.
Drawing on decades of historical data and current network growth, Michael Saylor projects that Bitcoin will deliver an average annual return of 29% over the next 21 years. He considers this the baseline. Any investment must outperform that rate, after accounting for risk, taxes, and time, just to be competitive. If it doesn't, it's simply not worth it. Saylor emphasizes that volatility is not the same as risk. True risk, in his view, is the catastrophic failure of the Bitcoin network itself, an extinction-level event. Everything else, price fluctuations, news cycles, emotional reactions, is just noise. He likens Bitcoin to a high-speed financial vehicle cruising at 60 miles per hour while most investors remain stationary. The crucial question is whether you believe the engine will keep running. With that perspective, Saylor argues that holding through volatility is not risky at all. The real risk lies in missing out entirely.
All of the things going on in the world, the war, the chaos, the competition, the inflation, the entropy, the passage of time, the hurricane, the COVID, vaccine, the COVID virus, all of these things impaired the value of your assets. The reason Bitcoin is going up, it's not an accident. It's because capital is economic mass. It is flowing from a high energy state, the mountaintop, to a lower energy state, to a more efficient state. It is steam condensing to water, condensing to ice, giving off energy, just like in any chemistry lab, you would learn this. And at the same time, there's this volatility driver, Tom, which is you have an open capital market, and on Saturday night, when there's a missile crisis, someone can make a $10 billion short bet, levered up 100 to 1, and panic. And they can do it in Bitcoin. And then on Sunday morning, when the missile crisis has passed and nuclear war did not break out, they can go long and they can reverse the trade. And Bitcoin's the only asset where you can sell $1 billion of it in a minute at 100 to 1 leverage, and you can buy $1 billion back in a minute with 100 to 1 leverage on Saturday night and Sunday morning. If you could do that with your Upper East Side apartment, then property values in the Upper East Side would also be more volatile. And if you could do it with Picasso's, that would be more volatile. Because if people get drunk and they panic and they short your asset 100 to 1 and change their mind 6 hours later when they get up with the hangover, you're going to have volatility. So the volatility is a feature. It's not a bug. It's because it's the most useful thing in the world from a capital market point of view.
Here's Michael Saylor with his compelling Bitcoin perspective. He compares Bitcoin to a massive dam holding back 500 trillion gallons of water, a metaphor for global capital trapped in inefficient or deteriorating asset. This capital is inevitably flowing downhill into Bitcoin, driven by what he calls economic gravity. Factors like inflation, debt, entropy, and time push this movement forward. Bitcoin harnesses that energy much like a turbine generating electricity from falling water. Its volatility isn't a weakness, it's a natural byproduct of this powerful force. If you don't understand why Bitcoin moves the way it does, Saylor warns you might confuse volatility with danger. But once you grasp this dynamic, you'll see that the real risk isn't holding Bitcoin, it's missing out on the flow entirely. If you found Saylor's insights valuable, please give this video a thumbs up and share it with someone who needs to hear this. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.